Okay, listen up. If you have federal student loans, or you're even thinking about getting them, you need to pay close attention. The entire system is about to be turned on its head. Starting in 2026, we're talking about a massive overhaul to, well, everything, from how you borrow to how you pay it back to how loans are forgiven. And yeah, these changes are going to have a direct impact on your wallet. So let's break down exactly what's coming and what you need to do to get ready. So to get our heads around all this, we're going to follow the journey of a guy named Sammy. Now, Sammy here, he represents millions of borrowers who are about to walk into this brand new landscape. By seeing how these changes affect him, we'll get a really clear picture of what this all means for you. And Sammy is definitely not alone, not even close. We're talking about a federal student loan portfolio worth nearly $1.7 trillion. This isn't just some small policy tweak, It's a fundamental shift that's going to send ripples through a huge part of the U.S. economy.
And experts, well, they're sounding the alarm. Someone like Sarah Saddlemeyer from New America is saying things are likely to get pretty bumpy. And that's because so many of these new rules are still being worked out. They're basically warning borrowers to get ready for a whole lot of confusion. The key to getting through it is knowing what's coming.
Okay, so let's dive in. We're going to break this down into 5 key areas. First, this new forgiveness tax bomb. Then, the new borrowing limits. After that, a huge shakeup in repayment plans. Fourth, a much tougher stance on collections. And finally, the most important part, what you can actually do right now to prepare for all this.
All right, first up, there's a major change that quietly kicked in on January 1st. And for anyone on track for loan forgiveness, this could mean a really unexpected and very expensive surprise from the IRS.
You're going to start hearing this term a lot, the tax bomb. So what in the world is it, and why should someone like Sammy be worried about it?
So here's the bottom line. A temporary tax break on forgiven student loan money, it's gone. It has expired. So now if you're on an income-driven plan, and let's say you get $50,000 of your loan wiped away after years of payments, well, the IRS is now going to see that $50,000 as income, and you'll have to pay taxes on it for that year.
And believe me, that has a huge impact. According to the Tax Foundation, a borrower like Sammy, who makes about $65,000 a year, could see his federal tax bill for that year jump by more than $10,000. Think about that, 10 grand. That's a massive, sudden bill to get hit with. For Sammy, that's not just some little inconvenience. That's a potential financial crisis. I mean, a surprise bill that big could completely wipe out his savings. It could derail all his financial plans for the future.
Next up, let's talk about what's changing for future students and their families. If you're planning to take out new loans, just know that the entire rulebook on how much you can borrow is being rewritten.
Yeah, this shows a major shift. Before, grad students and parents could pretty much borrow up to the full cost of attendance, which could be a wildly different number depending on the school. But starting July 1st, there are hard annual caps. We're talking $20,500 for most grad students and $20,000 for parents. Now, this is meant to stop runaway borrowing, but it could also put some really expensive programs out of reach for people.
And hey, this isn't just for grad school. For the very first time, if you're an undergraduate student going to school part-time, your annual borrowing limits are also going to be lower. Your enrollment status will now directly affect how much you can borrow each year.
Now, this is a really fascinating change. Colleges themselves will now have the power to set their own, even stricter, borrowing limits for certain degree programs. So, a school might decide to limit how much debt you can take on for a program that it thinks has lower earning potential down the road. It's a whole new level of control for the schools.
Okay, so we've covered borrowing. Now let's talk about what happens when it's time to pay it all back. The repayment system is getting a total overhaul, and one of the most popular plans out there is going away.
That's right, the SAVE plan. You've probably heard of it. It was known for having really favorable terms, especially for folks with lower incomes. Well, it's being phased out. And this is a huge deal for the millions of people who are on it right now.
And look at the scale of this, 7 million borrowers. That's how many people are currently enrolled in the SAVE plan. That's 7 million people, including our friend Sammy, who will have to figure out this transition and pick a brand new repayment plan.
Now, for anyone taking out a new loan after July 1st, things are getting simpler, but also a lot more rigid. That whole maze of old repayment plans is gone. Now there are just 2 paths, a new standard plan with fixed payments or a new income-based plan they're calling the Repayment Assistance Plan, or RAP.
Okay, now for what might be the most dramatic change of them all. For borrowers who fall behind and go into default. The government is signaling a major shift in how it's going to collect that overdue debt.
This right here shows a fundamental change in philosophy. Responsibility for collecting defaulted loans is moving from the Department of Education over to the Department of the Treasury. That's the same agency that collects your taxes. And trust me, that is a very, very big deal.
And this isn't just shuffling paperwork between offices. As one observer put it, this sends a crystal clear message. The Treasury has some powerful tools at its disposal. And this move basically says the government is getting way more serious about getting that money back.
So what does that mean in practice? It means the government can garnish up to 15% of your wages. It means they can seize federal payments, like your tax refund, to pay back that student debt. The era of pandemic protections, that is definitively over.
I know, with all these changes, it's easy to feel totally overwhelmed, but being proactive is your absolute best defense. So what should you take away from all this? What are the actual steps you can take?
Here's a simple checklist. First, know exactly where you stand. Log into studentaid.gov. If you're a future borrower, go talk to a financial aid officer now. If you're on a path to forgiveness, you need to start planning for that potential tax bill. And maybe most importantly, if you are struggling to make payments, you have to contact your loan servicer immediately, before you default and the Treasury gets involved.
The entire landscape of federal student loans is being completely redrawn. You've got a new tax liability, stricter limits on borrowing, fewer ways to repay, and much tougher collections. It all adds up to a brand new reality, and it's leaving millions of borrowers, people just like Sammy, to navigate a very different and much more uncertain future.